since we are running short of time, I'm not going to go into a spiel about everything that Tim can or will educate you on, but rather to just let him get into it with the proviso that everybody also gets into this. We'd like to hear all the questions, all those burning questions that you have, and I definitely can't help you, but I'm going to promise on behalf of Tim that he'll try and help you with that. And so with that, over to you, Tim.
Great. Hello. Well, it's a fairly small panel with me, and I'm not going to use any PowerPoint slides or anything. I think it will be more useful if we just have an informal discussion. So you're welcome at any time to raise your hands and ask questions or to interrupt or challenge anything that I say. I think a starting point to make is, there have been comments and discussions about IP valuation, obviously, over the last few days. Something that you have to bear in mind is that IP valuation has a number of different foundations. So perhaps the first foundation to refer to is the whole body of knowledge behind corporate finance and business valuation. So this is obviously, a well-established pool of knowledge. There have been Nobel Prizes awarded for aspects of business valuation and so on. So this is a very important area for IP valuers to be aware of. However, it's not the only body of knowledge. The other areas are obviously specific to intellectual property, and even although they're specific to IP, they kind of split into different areas anyway. So for a start, it's very important to understand the legal characteristics of intellectual property. It stands to reason let's look at another asset class. If you're buying a house, you want to make sure exactly what the rights are and understand what you're buying. The same applies to IP, and we had comments in the previous section how complicated patents can be. Similarly, trademarks and other IP can vary jurisdiction by jurisdiction. So yes, the legal rights associated with IP, this isn't a new area. They're specialists in that area. They're IP lawyers, patent and trademark attorneys, but that information really needs to be incorporated into an IP valuation. Another area we'll talk about are the functional characteristics. So if you think about brands or you think about technology, it's often not quite as easy to see how they work and how they add value as it may be with an office block or some sort of machinery. So with brands, you have to understand how are those brands influencing consumer perceptions and consumer behavior. And only then can you work out what earnings they might generate. Similarly, with patents or trade secrets, it can be highly complicated. You might require someone with a PhD in biochemistry or physics or something to explain it. But if you're just a valuer and a good business valuer and you understand all about spreadsheets and financial information, it doesn't mean that you necessarily understand about some sort of agribusiness technology. And finally, there are the economics of IP. So these themselves can be quite complicated. For instance, it can be, you can spend an enormous amount developing a brand or trying to develop technology, but it might have absolutely no value because it never actually gets market traction. So the title of this session is kind of from best practice to next practice. And I think the simple answer to that is all of these different kind of pillars or inputs to valuation. There is established best practice within those areas, but I think what I'd refer to as next practice in IP is the ability to integrate all of those kind of multiple disciplines into an effective valuation. So I've got a few case studies which might case studies or war stories, which might illustrate how things can go wrong if you forget about one of those legs or one of those platforms to a valuation. One thing I will mention, so there have been various standards for intangible asset valuation and so on. They've all been quite high-level documents. There is this new RICS, it's the Royal Institution of Chartered Surveyors. It's a international guidance note on IP valuation, and it's the first international document, I think, that really tries to go into the need to understand the legal, functional and economic characteristics of IP, and it also looks at IP in a fairly commercial context by grouping particular IP that might support a brand IP, or that might support technology, or that can support artistic content. So I think that's a useful document, not just for those who valuers of IP themselves, but also for those who might have to read an IP valuation report, or might have IP in their company, and they're thinking of commissioning a valuation for one reason or another. I think before you order anything, particularly professional services, it's quite good to have a background understanding, so you can ensure that firstly you're scoping the valuation properly, and also that you can maybe challenge the different people who are providing you with a proposal for that. So I've got some case studies and things, but maybe before we go into those, it's a good chance to see if there are any comments at this stage.
Anyone? Any comments? Or reserving it for after? Maybe, Tim, just tell us a little bit, you talked about legal and functional and economic. So does that mean then some of the things, the criteria that were used before were things like, profits and how much you can earn, or those excess profits, the sort of money, that cash flows that you can generate, and so on and so forth. They're now not less relevant, but you have to broaden the base now to take into account some of the other aspects that you were talking about.
Yeah, thanks for the question. It's an important one, actually. So all of those, let's say those financial, the number crunching, the earnings analysis, the risk analysis, and so on, that's just as important. But I think the key point is you can't make really good assumptions if you don't understand the characteristics of the asset. So for instance, if you misjudge how strong the legal ownership is, you might think, well, this technology we can protect for the next 10 years, whereas in actual fact, you might not be able to protect it because there's some sort of problem with the patent claims, or it's a patent application, not a granted patent. Or similarly, you might think, oh, well, here's a brand, it seems to have a 10% price premium, it must be a really strong brand, it's a great brand, because you're just looking at those financial measures. It might be that that price premium is just due to some sort of distribution advantage, not because people love the brand, and the minute you lose that distribution advantage, that surplus profit goes away. So you've been able to see the price premium, but you've incorrectly attributed it to the brand rather than another asset within the business. So yeah, that the financial analysis is still crucial, but it's that better visibility, probably that better understanding of what's driving or what's causing that financial performance.
Okay, we don't want this to be a chat between Tim and I, so anybody else? Yes? You had a question? Yes? Now I'm sort of waving, hoping that more people will get up and ask questions. But yeah, since you've admitted to it, so let's have you at the mic and ask your questions.
So the question I have, Tim, is in terms of your case studies, are there any case studies that you have in the publishing space?
Yes, there are actually. The first one that comes to mind in the publishing space it's a fairly unusual situation. I wouldn't have thought about IP valuation, but it was actually in the family court in Australia to do with a divorce, basically. And the one partner, former partner in this marriage, was a very kind of well-known celebrity, and she had various publications and cookbooks and things like that. And this was obviously putting a value on that IP was part of the settlement. The interesting thing is the forensic accountants on the two sides had sort of thought there wasn't really much IP, because they thought, oh, this is all just goodwill to do with this celebrity's, her own reputation. But she had trademarks, in a number of product categories. There was already a catalogue of published material. So there clearly was intellectual property, and that needed to be valued. So, as with other things, one has to identify, well, how well was that personal brand, how well established was it, what earnings potential was there, not just in let's say, cookbooks and things like that, but there were also various brand extension opportunities, and there were already some licenses, in terms of using that name on cooking products or food products and things like that. And as with any type of IP, you have to think about the useful life of that. So yes, you might have some books, the copyright is there, but perhaps they haven't been published. What sort of sales do you think they'll achieve? How long do you think they'll carry on generating sales, etc., etc.? So there certainly are, I think, quite a lot of instances where IP valuations are important within the publishing industry.
Hi, just a question. Are there cases where IP values are inflated to get funding for abuse, possibly? And then secondly, let me see, are there measures to protect borrowers, number 2? And then for small companies that source finances, and if there are any abuse of inflated IP values, what areas should small companies focus on to ensure that their IP valuations are quite reasonable so that they can secure funding?
Okay, so look, there certainly are examples where IP valuations are either inflated or deflated. So sometimes, let's say for tax purposes or something, it can be in the IP owner's interest to have a lower valuation. Let's say they're shifting IP from Malaysia to another country, and they have to pay capital gains tax on the sale of that. If they're selling it to a subsidiary or a related party, they might want to have a lower value. So you can get poor quality valuations. I guess the first thing in terms of how can you, either as someone who's commissioning a valuation, or if you're using a valuation in a transaction, first and foremost, I suppose it's the reputation and experience of the valuer in question. So, some valuers will be registered valuers of one sort or another. So it's checking up whether that's a body that is well known and well respected, and also whether it has sort of compliance and quality control, because certainly RICS, if you carry out poor valuations, you get struck off their list of registered valuers and be kind of publicly denounced. So those are important aspects. Ultimately, a valuer kind of lives and dies by their opinion, because a valuation isn't a precise science. You've got to exercise judgment, and if you are shown to be a gun for hire, I think your credibility goes down quite a lot. Something else, though, to bear in mind, increasingly valuations will be peer-reviewed, or they'll be cross-examined, if it's for litigation or something like that. And this gets back to, those different foundations I made earlier. So let's say you have someone doing a valuation of biotechnology IP, who's a fantastic scientist and understands the technology and all of that sort of thing, but doesn't have the corporate finance background. that valuation report will be strong in some areas and weak in other areas, but it's as weak as the weakest link. So under cross-examination, you get a financial expert sort of interrogating them about assumptions regarding the discount rate or something like that, and the whole thing would fall flat. So I think unless you have each one of those platforms solid, there is a risk to the valuation. Just in terms of how can you protect yourself as an SME or anything like that, I guess it is choosing a valuer who does have good professional credentials, who does have affiliation with some sort of professional body, and does have a good track record.
Questions? Okay, one quick question before you go into your war stories. Everybody says we've got to get more accurate valuations done. I mean, that's the ultimate aim. So you get really the value of that IP, or you maximize the value of that IP. But when you start going into the world of brands and you get into things like emotional connections and so on and so forth, doesn't that then make the job harder rather than easier? I mean, you take a bigger cross-section of things to look at, but then you also make it a bit more waffly.
It's interesting. People with brands always think of kind of fluffy measurements and kind of soft measurements and so on. You can get really good quantitative consumer research about brands. So obviously the first thing is to understand whether anyone's heard of it. So you can say, oh, I've got a trademark. Is it valuable? If no one's ever heard of it, it's probably not worth anything at all. But just knowing about a brand on its own isn't enough. So you have to make sure that they're positive attributes, positive perceptions. So those might be perceptions of quality. People think, oh, this is really high quality, or there might be more image where people are thinking it's very trendy, or it's a very innovative company. But ultimately, all of those are integrated into some sort of preference. Now, market research companies are very good at carrying out quantitative research, and marketers use the term brand equity. It's kind of the brand love, the extent to which people know and like and love a brand. It's just like a relationship with an individual, really, I guess. But that can be quantified, and you can compare that one brand against another in the same product category, and you can see, well, they've both got the same level of awareness. People think they're both quite high quality, but this one's regarded as a little kind of old-fashioned or not quite so cool or whatever, and therefore amongst a particular target market, they've got a stronger preference for the one over the other, and that information then can get fed into the financial assumptions within the valuation. So, for instance, and the MIPO IP valuation model, it has a preference. It's an income approach of valuation, and it's called the relief from royalty method. It's basically saying if you didn't own a brand but you had to license it from someone else, what sort of royalty rate would you have to pay? And then saying because you own it, you're saving that royalty rate. So you can almost forecast the sales into the future and use that royalty rate to calculate how much you're saving each year and bring that back to a present value. Now getting back to that brand equity, that quantitative research, those two brands we were looking at where we said one's got a higher brand equity than the other, you would use that to choose what sort of royalty rate, if you were valuing both of those, what sort of royalty rate do you use for the popular brand and the less popular brand. You'd also do some benchmarking. Let's say it's food and beverage. You'd do some benchmarking. You'd get to understand the royalty ranges within that product category, and then you'd use the quantitative research to say, well, we're applying a higher royalty rate to the popular brand than to the other. So that's the sort of integration, I guess, between the consumer research, the licensing, the benchmarking of royalty rates, and then the financial number crunching. And actually, I will toss in a related war story. So this goes back to years ago when I was based in London. We did some work for a private equity firm, and they'd purchased what they thought was a linoleum flooring company based in Scotland. It turned out only after they'd made the acquisition that they noticed they'd actually acquired some trademarks for the Hunter Wellies brand. And it turned out that at the back of the factory, they made some Hunter Wellies. The reason it didn't even come up on the information memorandum was the business was very small, it wasn't making a profit, kind of the sellers didn't think it was particularly important. So they'd acquired these trademarks for zero, basically. And they realized, it gets back to this concept of brand equity, they realized that actually there were some very positive image attributes associated with this brand. It hadn't been marketed pretty well, but it had this good heritage, it had good product quality, and they started marketing it better, tweaking the product designs a little bit, and soon Princess Diana was seen wearing Hunter Wellies, Kate Moss was seen wearing them at Glastonbury Music Festival, and was a very valuable brand. So if you just looked at the historic sales, you'd have probably agreed, or just looked at the historic profitability, you'd have agreed with the seller that there's no value in this thing. But this brand equity it showed that there was potential. So a really well-known marketing academic in the UK, Tim Ambler, he refers to brand equity as a reservoir of future cash flow. And I think that's a great term because it's showing, well, if you know that the brand equity is strong, that goodwill, that brand equity can translate into future cash, future sales, and future value. So if you're trying to do a valuation without understanding that, you kind of a little bit blinkered and you might come up with the wrong answer.
I think first of all, I missed out on the name of the survey that was done.
It's RICS, the Royal Institution of Chartered Surveyors.
And we can get that online?
Yes, you can. I'll make sure we send through a link as to how you get it. Unfortunately, you have to pay, I think it's £20 to get it, but asking the question, I'll give you a paper copy afterwards.
Yeah. Okay. There are various methods for valuation. You know, what would be your preferred, you know, or your method of choice, and you know, what are the ingredients and that would make you know, that's necessary for you to have a good, thorough and comprehensive valuation of an IP, one that has not seen commercialization yet.
So for any type of asset, there are three approaches to valuation, and within those approaches there are different methods. So the approaches are the cost approach, the market approach, and the income approach. So cost approach is pretty much saying, one of the most commonly used methods within the cost approach is saying, well, if you couldn't buy that asset from someone else, how long would it take, or how much would it cost you to develop one of similar use or similar utility? Okay. Now, you know, that in some types of assets that's quite useful to say, well, this is how long it would take to build a new factory or something like that. What you have to bear in mind, though, is it's not just the direct costs, because if it's going to take you 6 months to develop new software or a year to develop new technology, there's an opportunity cost. While you're busy doing it, you're missing out on being in the market and earning profit. The weakness of the cost approach for certain types of IP is there isn't a direct linear relationship between cost and value. So I'm sure you've experienced lots of R&D projects, millions of dollars spent or millions of ringgit spent, no value. Or similarly, lots of brands, there's a big marketing campaign, it just dies and it never gains any action. So perhaps for software and things like that, cost approach can be okay. Very early stage technology, it's okay, but it's often not the preferred approach. Market approach is great where there is an active market for homogeneous assets, shares or houses. We all do it anyway, where you say, well, a house on the same road as us has sold, it went for so much, but it's a bit smaller than ours, or it's not as smart as ours, then maybe my house is worth more. It's just that benchmarking where you're trying to find an example of a sales price. So it's a sales comparison. The problem with that for IP, a couple of problems. One is there isn't an active market to the same extent as there's for property. The other is, and it was referred to in the previous section, by implication, each piece of IP is unique and different. So that benchmarking is more difficult. Having said that, it can be useful. So let's say you're valuing some sort of pharmaceutical patents in to do with Alzheimer's disease or something like that. You might be able to find some comparables which are giving you kind of broad reference points, but often they're not going to be good enough to really go through the benchmarking and come up with a robust opinion. So that gets us to the third approach, which is the income approach. And that's really where you're saying an asset is worth as much as you expect it to generate cash flows or earnings, also taking account of the risk associated with assets, with that asset. So, with technology or brand, you're forecasting the future revenue, you're gauging the risk using kind of corporate finance methods, but also taking account of your understanding of those assets, and you're saying, well, we expect it to earn 100 ringgits next year and 1 million ringgits the next. Let's bring that back to a present value. You mentioned products or technology that hasn't been commercialized. That can complicate the income approach, but it's still often still useful. So I can provide some examples. Just touching back on MIPO's IP valuation model, they favor the income approach, and that in many situations would be the preferred methodology, as long as one can come up with sensible assumptions. So where a product hasn't been commercialized, you can't say, well, we had sales of 100 last year, what do we expect them to get next year? Or you can't say we've already got royalty income from that particular patent, let's use that as a basis for growth. But you can still, in some instances, carry out good analysis and come up with commercially relevant assumptions. So pharmaceutical is one where you've got very clear development hurdles. You'd say phase 1 clinical trials, phase 2A, phase 2B, phase 3, etc. Also with a lot of kind of engineering-based products, you can work out, well, have we got up to a prototype stage? That there might be predetermined stages. Have we come up with a small-scale plant? Have we got to commercial production? If you've still got a number of those stage gates to get through, you'll have to assess the likelihood of getting over each one of those hurdles. You can get very good data, for instance, in biotechnology, and you can estimate the cumulative probability of success of reaching market. You then still have to forecast the market penetration and market sales. So obviously the further you are from the market, the more layers of assumptions you have in an income-based valuation. And obviously as a valuer, you have to convince yourself that you've been able to come up with good assumptions, and also very importantly, you've got to be able to articulate that so that the reader of the report kind of finds it commercially relevant. And perhaps that gets back to your earlier question about the quality of a valuation report. Does it make sense? Is it a robust valuation? And I think ultimately, value is the same as engineers or scientists or others have their own jargon and things like that. But a good valuation report should be easy to read. And it shouldn't just say, well, we think it's 1 million ringgit, that's it. You should be able to get all of the building blocks of that value in the report. and perhaps the next war story I'll use, it's a happy story maybe rather than a war story, perhaps explains that. So, even if it should pass the commercial sense check, I guess, where you look at that, particularly if you understand the industry or that particular technology type, you should be able to interrogate it. People use the term kicking the tires of a car when they're buying used cars. It's much the same. So yes, it might be an intangible asset, but the report should make it possible to kick the tires, and the valuer should be confident enough that they kind of really showing, making it as transparent as possible, how they've come up with the assumptions and how those have influenced the value. I can pause or go into the next story. We have a question.
Yeah, is there a sense that the software world is leaving the IP world behind because it's moving so fast? If you do a search of Uber and IP, you hardly see any rankings articles coming up, and that's valued at 40 billion. So, and then even with WhatsApp, there was a group from Tencent that wanted to buy these guys out, and they were in their office in the Silicon Valley. They couldn't agree on valuation, and one of the lead guys from Tencent looked around and said, there are 40 engineers here. We can go back and hire 1,000 engineers and build a similar product. And even that didn't sway the guys to sell. And it was, I think, in the mid-single-digit billions, and they wanted to sell for higher. So the Chinese went back, right? And they built their own app. And I just coincidentally ran into someone yesterday who knows one of the developers, one of the legions of developers that Tencent hired. They actually have 5,000 developers behind this app called WeChat, and they've crossed 500 million users. So I guess both sides are happy in this case. But this thing about the cost factor when you evaluate a piece of software, right? So that's what the Tencent guys went, we can put this many bodies behind it. We cannot agree on a price. So that's quite interesting. But the basic question is, is the software world leaving you guys behind in how fast you're moving?
You can almost hear my brain clicking through that, because there are a lot of interesting components to that. Look, I think a lot of very successful businesses and some of those kind of newer businesses that have developed rapidly, there's a very interesting link between the different categories of intangible assets that they've got. So you might look at them and see, they're valued at 100 billion or some huge figure, and they've hardly got any tangible assets, and you're saying, what's the rest? Now, those links can be very close. So yes, often there is a kind of software platform or something that's the real foundation asset of the business, but at the same time, then you get the network effect. It's that number of users, and that kind of has a huge impact on the value, and you can also kind of get the brand impact building on that. Now, brand in those instances is often, it's kind of taking the uniqueness or the innovation or the achievement, and it's going into building the reputation of the brand itself. Now, it's quite hard then kind of slicing and dicing the value and saying, well, exactly how much is attributable to the software as opposed to the network, as opposed to the brand, as opposed to various other aspects of know-how. You can certainly do it, you can make sensible estimates. We use a process of value mapping where you're almost just trying to work out not just the size of each one of those assets, but also the kind of interactions between them. The other thing to bear in mind, I guess, is the current software platform, its useful economic life might be quite short. It might only be, 2 years, 3 years, who knows what it is. And you've also got to make sure that you're generating, the next generation of software. So certainly from a strategy point of view, valuation can be really useful, not trying to get a precise valuation of each one of those, but really, if you think about it, the cogs in a machine, I suppose, trying to work out the size of the different cogs, how they fit together, and how they generate cash flow. I don't think I've really answered your question, though, but in terms of there are a lot of businesses where software has been absolutely fundamental. In some instances, there will also be patent protection over various parts of that. There can be copyright associated with it, but copyright is just protecting the kind of expression of that rather than the the underlying mechanics of the business. So I think wherever possible you have competitive advantage, it's making sure that you're building as big a wall to provide the monopoly. So even where there are patents, the more sophisticated IP operators will talk about a thicket of patents because they're a bit sort of scornful of a onesie, a single patent, because often that's easier to design around, whereas if they get a thicket, it's this broader protection. So all of that is kind of very much an IP strategy, but when you're valuing the IP, you also need to think about that. And in some instances, you have to think about, well, are we valuing a bundle of intangibles, which is made up of software and patents and various other things, or are we just valuing the software as a standalone asset? And you talked about whatever it was, the 5,000 engineers. Maybe you'd have to get into some sort of replacement cost, but you could have those 5,000 engineers and still not come up with anything that works.
Wouldn't your strategy then be in heading towards evaluation to think, well, something like software, because it only has a very short or small, economic lifetime in that sense. So and it might have a big discount factor because of that. So I would just go quickly and get the first mover advantage and go for my valuation on the basis that I'm first in, I'm going to make all my money in that, and then I'm going to move on to the next thing. I'm not looking at this as an IP and a value that I'm going to keep for the next 10 years, say.
Yes, in that instance, obviously the speed to market and first mover is really important, but at the same time making sure that you do have some IP lawyers and so on working behind you to try and build a bit of a fortress around what's good. But yes, you can't write in some markets that the speed is essential, and you can't spend too long counting your pennies. You've got to get into the market.
Hi, taking on non-commercialized assets. Do you have any war stories where you actually did a valuation, perhaps using real options model or something, as what you described, and placed a value in a non-commercialized asset, and then 5 years later, perhaps when it's commercialized, look back again to see how far or near that value is once commercialized?
I've got an example I can use, but I suppose one thing is it's quite weird being a valuer because there's no exact answer, and probably every valuation you do could be proven to be wrong if you're looking for a precise answer. But if you, hopefully as a good valuer, most will be proven to be in the right ballpark, to be kind of sensible commercial valuation. So one that we did very recently actually, and this was technology that hadn't been commercialized yet. So it's a kind of particular type of drilling technology to access shale gas and geothermal gas reserves and so on. Now, this company had been around for a while with different inventions and things like that, but this particular technology had zero revenue. They'd had a prototype, but it wasn't actually being used on a commercial basis, so zero revenue, and even the previous inventions and so on, the company as a whole was kind of very small. The valuation that we were asked to do, the owner was looking at two options. One was getting funding from an investment bank. The other was possibly selling an equity stake to a trade buyer. But was very aware that the valuation report would kind of really have to articulate whatever the findings were. So within this, the first thing is to look at the product itself and say, well, what is special about this product? And there definitely was something special about it. So there were previous gas deposits which were uneconomical, smaller deposits, which existing technology, bigger drilling equipment and so on, you just couldn't really access that and make a profit. Whereas with this new technology, you could. Okay, so there was something special about it. But the next bit was quite tricky because you might have a special product and you might have a few patents associated with it, but it doesn't mean the patents protect what's special about it. So we had to work quite closely there with the patent attorney to try and work out the extent to which the claims protected the unique features of this product. And that was probably the hardest bit, and then also be able to articulate that to any reader. So yes, special product. Secondly, the patent claims could give really good protection. The next building block, I suppose, of the whole thing was to say, well, how attractive is kind of shale gas and geothermal? And we had a little section in the report, really attractive, lots of good things. Next bit is, will it be possible for this technology to be used? So we had engineering reports and so on, which kind of helped prove the fact that it could access these, and it had the following cost benefits and so on. But the company had already entered into some early stage agreements with various potential customers. So again, it was saying, well, not just is it special, not just is the market attractive, but there are interested parties. So you almost got the start of an order book. All of that was then brought into the valuation report. Ultimately then, using the income approach, we looked at the number of customers, the number of applications, and substantiated the forecasts that the company had developed. Used the relief from royalty, came up with the value range, and I found out fairly recently the company had gained tens of millions of equity finance just for a minority stake. So I think, it gets back to that. The valuer doesn't have perfect knowledge or doesn't have the crystal ball to look into the future, but for the investor reading that, they could kick the tires. They could say, well, these are the different assumptions, these are the different building blocks. It's worth investing in. So yeah, it's trying to make things as visible as possible, I think.
Okay, looking to the back of the room, you've been very quiet compared to the noisy ones in front, or the more curious ones in front. When should you start getting your IP valued? At what stage?
I think an important thing to state is that if one's carrying out a valuation for litigation or some big dispute or something like that, you have to have a very detailed valuation report, and that can take time and it can be quite expensive. There's a much broader spectrum than that. So if we put that at the far end and saying that's the kind of Rolls-Royce type of valuation, they're much simpler indicative valuations, which are obviously perfect for a particular use. So, I would say getting an understanding of not just the current, but the potential value of your IP, and also the value implication of alternative strategies can be hugely important at an early stage, but often that's more kind of order of magnitude, really. We're not saying is it worth a specific amount, but saying, well, is it likely to be worth a small amount or quite a big amount or a high amount? Or if we're comparing strategies, it's really that relativity. One strategy is worth more, going to generate more.
So presumably you would want to audit at a different point in time then to see.
Yes. Yes. So audits may be too strong a word, but certainly review that. The other important thing we find is that whole process of understanding the market and the technology and the competitors and so on is kind of really stuff that the business owners should know about and think about, but they're sometimes too caught up in developing what they think is fantastic. And it's once you start identifying those factors that they do get brought into the strategy. You do start perhaps identifying certain milestones, or you might say, well, actually getting to market soon is essential. If we go it alone, it's going to take us 2 years to get to market. Maybe we can do a joint venture and we can get to market in 6 months. We might have a smaller equity stake, but it's going to be better. So I think that having that, I always call it a line of sight or visibility, really, between what you're trying to do and what the value outcomes might be. And scenario evaluations can be hugely useful for that.
So how does the profession keep up to date with what goes on in the ecosystem? Like, do you guys go back at the end of 3 years and relook some of the valuation you've done and said, oh, this this worked really well or this was way off track as a way to learn, right? So I'm
Yeah.
not sure whether you guys do that or not.
I sometimes feel like I'm a hamster on the wheel. You know, the wheel's spinning and you're running just to stay in place. But I talk to people like you, so to learn. But one has to plug into as many networks as possible. And Griffith Hack, the firm I work for, it started off as a patent and trademark attorney firm. Now it's kind of full service IP. But you'd have different people in different technology areas and going into different networks and things like that. So one's continually trying to listen and learn. We also get involved in IP transactions, which I think is really useful because sometimes you can get a bit lost in a spreadsheet, and you've got to be aware of the difficulty that you can achieve and that you can encounter in selling patents, for instance.
But you don't specifically go back and relook some of your own valuation reports for clients after 2 years and look at some of the assumptions you guys had made. Oh, we were really off here, we were really wrong. And look at your peers too, like in the industry. So everybody learns from each other's valuation report because there's an element of guesstimate too, right?
Yeah.
So
I'd call it judgment.
Judgment. Yeah, it looks better when you're charging the client, right?
Look, in terms of going back, we do, and with some clients where one's doing that sort of strategic valuations and you are reviewing the milestones and where you're getting that's happening automatically. Another factor, though, that you have to bear in mind, if you're doing a valuation to support a sale or for tax or for litigation or something, you're always doing the valuation at a particular date. So there's that as at date. So if there's some massive change in the market or some groundbreaking technology happens 1 month later, that's not relevant to the valuation. So even if I might get commissioned now to do a valuation as at 2013, just because that's the date of the legal dispute, I've got to ignore anything that's happened since there. So you can't have that benefit of hindsight. You've got to do it as if using information available at that particular date. So it does get back to the factor that most valuations will be wrong because you don't have the crystal ball, and there'll be some things you couldn't have forecast, but there'll be some things that you would have been negligent of if you hadn't thought about, or some sort of due diligence or some sort of review would have identified those.
Yes.
You talked about science and technology in terms of valuation. The new emerging field probably in this area is nanotechnology. Has your company done any valuations in nano applications or nanotechnology in commercialization?
Okay, so the question is about nanotechnology. Slightly adjacent, but it had nanotechnology implications. We did some work on quantum computing. And quantum computing, the whole concept goes, you have one quantum computer, it will have the same processing powers every single computer in the universe right now, but they're quite far into the future if they materialize, perhaps 10 years in the future or something. And we're doing some work for a research institute focusing in on quantum computing. CQC2T is the institute name. But the interesting thing, and this is what's got us into nanotechnology, so the initial question from that research institute was, let's have some strategic advice on our patent portfolio. And I said, well, we can't really do that unless we have the broader context in terms of what you're trying to do. And we also worked out, well, we can't just look at your patents, we also have to look at the kind of know-how and the research capabilities and so on. And the way we recommend to the client, we said we need to look at some end markets and get to understand where your technology can be used, and then bring it back towards a gap analysis, I suppose, between your patent portfolio now and what you'd really need in terms of commercializing it. So look, their core function is research. They didn't want to deviate from that, but we're just saying to have this broader commercial strategy, you can obviously fund your research better. But the interesting area, once we identified the potential uses of their know-how, not just their patents, there were some which were much more immediate, almost spin-off benefits, and some of that was existing know-how and existing patents that had applications in nanotechnology. Now, the interesting thing is they hadn't even identified those applications because they were doing quantum computing rather than saying, well, as a byproduct of that, we've got something that's really useful for microchip processing kind of almost immediately. So I think the benefit from that is just trying to match the markets to the capabilities and make sure that you are aware of the market needs and that you're developing IP or constructing patent claims that are appropriate for those markets. Because we did find that some of their existing patents weren't thinking about more immediate kind of microprocessing applications and so on, and they needed to give more thought to the scope of the patent claims. So that's a bit of a sort of obscure look, I guess, at nanotechnology, but it was sort of going into that space.
But in terms of commercialization of nanotechnology, today it's about a $3 trillion market.
Yeah.
With L'Oreal probably leading the way in terms of application for consumer products. So which kind of organizations are doing those valuations?
I couldn't really answer in terms of the extent to which different firms are doing nanotechnology valuation. So I'll just mention another aspect. So within our valuations, be it in nanotechnology or any other area, we have a patent analytics team who kind of sit next to me basically. So that's a really useful insight, both into who's carrying out inventions, who's got patents in that area, and also who's writing research papers in a particular area. So those are just other information sources. So in terms of the breadth of the valuation work that I do, it goes pretty much across sectors, but where I don't have, or my team doesn't have, that direct valuation experience, we'll make sure that we have technical experts providing input to that, and we'll then, obviously have to bring that through into the economic analysis.
Hi. Just curious to know, what was the highest valuation that your company did in terms of value? And maybe you could tell us a bit about, why it came out to that value.
I haven't actually got a league table of highest, but some of the biggest ones will have been brand valuations, supporting really big corporate transactions. So, where companies buy another business, they have to separately value the identifiable intangible assets to report them on the balance sheet. They can't just put everything in, all the intangibles in under goodwill. So for instance, when SAB Miller bought the Miller Brewing Company, that was several $1 billion worth of brand value. I've done a lot of valuation work for Shell, so this isn't for financial reporting anything, it was for internal management purposes, and that was looking at significant aspects, for instance, the brand in the chemical business, the brand in the retail fuel business, and other areas. So obviously some massive valuations on that front. But those ones are all confidential, so I can't give the actual dollar. And I've done valuation work for Petronas actually, in the retail business within Malaysia. So that was primarily focused in on brand, and as you'd imagine, the Petronas brand is worth a great deal.
More specifically, relating to my earlier question, something that has not been commercialized yet, technology or that it is based on the income-based method that you.
Okay, the one I'll use as an example, it's not specific to the bigness of it, but it's a massive big mining company, one of the biggest mining companies globally. They'd had a big R&D project looking at a particular area of technology. They'd spent more than $10 million US dollars on developing this technology. They'd then sold off a particular subsidiary and they didn't really need that anymore, so they'd kind of mothballed the whole R&D team. A lot of the team who'd been involved in that had left the company, but they were still left with an international, several patent families, international filings. So there was quite a big cash outflow just to keep those patents alive. And they came up to us and said, look, we've got no intention of using this technology. What should we do? Should we just terminate the patents, or could it be of value to anyone else? And this was kind of interesting one. So obviously within that company they had tons of IP knowledge, they had tons of technical knowledge, but they'd kind of lost the technical knowledge associated with those patent families, but they had no idea of the economics. So for them, the value of those patent families was negative, because it was just a sure cash outflow and no prospect of actually using it themselves. But once we looked at the market, once we looked at the technology area, once we looked at likely licensees or purchases of this based on patent analytics and based on a review of licensing royalty databases and so on, we were able to identify that this was really good technology. It still had some development hurdles to overcome. They had lost some of the know-how which kind of supported the patents, because they'd fired all of the people who were doing that. But the report was just looking at the upside potential and also balancing that off against the development risk. So it came through as, don't just leave these things lying on the shelf. Don't terminate them. It's worth either selling or licensing them, but here's the information that you have to kind of assemble and pull together to do that. So, and that particular case study is still in process.
Okay, we've got a few more minutes. Yes.
Valuation, where they've done all three methods, income, market, and cost, and they average it out. Is that a correct practice? Because the variance was quite great between income, market, and yes. Is that correct?
I wouldn't average them out. I think firstly it's a good thing that they use different approaches, different methods, because quite often you'll find that not one of those is kind of perfect in its own right, but through a sort of process of triangulation, either of particular assumptions or through the output, you can start narrowing the range and coming up with a better opinion. But I think it's a bit of a cop-out to say, oh, well, they're three, they're all just equally good, let's just average them. I would think long and hard and say which one I thought was the best approach. I would also use the findings of the other two to challenge the assumptions of the first one. So you might go back and say, oh, my primary approach is coming up with a higher number, let me go up and have a look at a few of those assumptions, and maybe I need to just turn the volume down a little bit. So ultimately I'll try and narrow the gap between them. Similarly, if I was looking at market comparables, I would give, and that was a supporting method, I would give some more thought as to how comparable they were or whether further adjustments were required. So I think ultimately as the valuer, you've got to make the tough decisions. You've got to say, this is my primary approach, these are the corroborating approaches, and you've got to, as far as possible, try to kind of marry them up and use one to inform the other.
You spoke about brand values and some of them being the largest that you've valued before. Typically, we use the relief from royalty method as one of the common approaches in terms of getting the value. So I've come across these reports where Interbrand comes up with brand values, and they do it on an annual basis. Is the relief from royalty method the typical approach that they use, or is it something else?
Interbrand use a different approach. It's more of a profit split approach. So rather than applying a royalty to forecast revenue, they look at the profit of the company, they make a charge for kind of the tangible assets, and then they use an estimate they call roll of brand to work out how much of that kind of surplus profit they'll attribute to the brand. I guess one thing I would say, just a bit of a word of caution, this is not specific to Interbrand, but there are league tables for brand valuation. So Interbrand do one, Brand Finance does one, Millward Brown does one. Now those are just using publicly available information. They largely are a public relations exercise, to increase the visibility of those companies. They are quite interesting. I think they serve a role, and you can look at the relative value and changes and so on. But they are not meant to be robust valuations. They're not based on detailed financial analysis because they don't get the data from those companies. They're often not based on good quantitative research, although the Millward Brown one has some insight into brand strength. So they very much here's a rough estimate. It's kind of quite interesting to see what's happening, but they're not a formal valuation opinion.
Assuming you have determined an approach for the valuation, are there different assumptions depending on the purpose of the valuation? And if so, are there different assumptions or factors for consideration if the purpose is for IP financing?
So the assumptions would always be similar in terms of the specific assumptions you'll look at. The level of detail you go into, this is more scope than the application, but when you're doing a valuation, you can say it's an indicative valuation or it's a very rigorous valuation. In some purposes, you would have to come out at one point or another in that scope. So for IP financing, you have to make sure that it's a firm opinion. I think the only factors that might influence your judgment a little bit, and for instance in the MIPO IP valuation model, they're stressing that they're looking for reasonably conservative opinion. So a valuer is you used the term guesstimate and I said judgment. There's always a kind of reasonable range for most assumptions where you can say, well, could the royalty rate be 2.5% or 3%? You can narrow it down, but it's not particularly right. It's not to say 2.5 is better than 3. You're happy with that range. You know that 4 is wrong, you know that 1 is wrong, but within that range you're kind of comfortable with that. It might be if you're doing the IP financing, you would go lower in that kind of reasonable range than you would in another. I think the most important thing, though, again, is to make sure that that's all clearly articulated to the reader of the report. And we always at the end say, look, in our opinion, this asset is worth such and such. We had also just identify some factors, kind of swing factors really. It's not to back away from our opinion, but to say if in 2 months' time the prototype's proven successful, or if in time the brand extension into a new country proves successful, this will increase the value, but hey, at this date it hasn't happened. So I think again it's just making sure that the valuer is the reader of the report is confident in your opinion, but also understands factors that could influence the value.
Okay, we're fast running out of time, so anybody else with questions is going to have to take this offline. I'm going to give Tim maybe... Oh, I can't give you 1 minute, can I? Okay. I'll give you 2 then, to sort of wind up. But also, I think placing it into perspective, because everybody's talking about, unlocking the value of Malaysia, more than 50% of the assets of companies, intangible assets. You talked about 250 billion in yes. ASX 100 companies, being stuck there, unrecognized assets. So these methods of valuations, as we're moving towards best practices, is there buy-in from accountants, from banks, from VCs, and so on and so forth as a closure? Yes, there is increasing buy-in. There are a whole lot of audiences, I guess, a whole lot of stakeholders, users of reports, and there is increasing buy-in. There often is a fair amount of ignorance, perhaps, because not so much IP is on the balance sheet. So a lot of people who don't come from an IP-centric background, they don't get it initially. But if you're able to communicate the value of your IP, and I'm not now talking about a precise value, but just show how vital it is to your business model, show why your business is likely to be more successful because of the IP, I think you can really start the conversation with these people. So with that whole range of stakeholders. The other thing I would say is, sometimes I'm talking about kind of the guidelines and the standards and the real technical nitty-gritty. Don't get too frightened off by that, basically.
I think the broad valuation skills are so important, or the broad valuation tools are so important to businesses, whether it is a multinational or whether it is a startup or whether it is an SME, just to gauge what these different assets are contributing to your business at the moment, how you could increase that, how you can protect it. So it's risk management and strategy development, and having a value-based approach both to risk management and strategy development is really useful. Sure, there'll be situations where you need a report for financing or for various other things. Obviously, then you need to commission someone and get the detailed report done. But even if you're just carrying out some fairly rough and ready value estimates, trying to understand how important your technology is versus your brand versus your human capital versus other things, I would encourage you to do that, and don't pretend it has to be accurate. It's better than ignoring it.
All right, on that note, thank you very much. Big round of applause for Tim. And just in time to announce lunch at Ballroom A, and breakout sessions will resume again at 2 p.m. If you're interested in this line of conversation, our next session in the specialist theme or track is IP financing and collateralization.